and thank you for arranging this great seminar. And thank you, Gavin, for making my life so much easier, because I think you just cut down half of what I wanted to say in terms of why gold. That was a great introduction, which reminds us the importance of diversification, because a lot of the time the questions are around, should we allocate some of our portfolio to gold? A lot of the work we're doing is around mentioning families and investors, the need to diversify. And I think, Gavin, you pretty much proved the case for it. So you make my life quite easier. So I'm going to share with you in the next 20-25 minutes what we call the physical gold or physical precious metals. How to do it. I'm going to touch on actually some of the topics Gavin mentioned, like authenticity, liquidity, the price risk, which Gavin mentioned as the cons of commodities or alternative assets versus the advantages. But before I start, I'd like to start with the basic, and the basic is why gold. And why gold? And we talk mostly about gold, but actually when we talk about precious metals, we're talking about gold, silver, platinum, and palladium. I'll touch mostly on gold, a little bit on silver. Platinum and palladium are we can discuss in the Q&A if we have some time. So the first question I will start is why gold, and we go down to the basics of this asset class. And the first reason comes to mind is just gold has been part of our civilization for millennia. It's been associated with wealth and prosperity for 4,000 years since ancient Egypt. I like to think of gold as the money before we invented money. In this regard, and I will dispute some of Gavin's observation with due respect, but we often think of gold being placed under the label of commodities or alternative assets. I beg to differ. I think there was gold first. There were other assets later. So in a way, we're looking at the first actually investment asset the world has known, and the rest comes later. And I do look at it not as a commodity and not as a cash, but as something in between. And I'll mention that in a moment. So to culture, gold has value as a culture, civilization. And again, if you think of the Oscars, the Olympics, it's all around gold, which makes us, it's safe to assume gold will remain part of who we are for the next millennia as well. Now, the second reason is the gold has a very stable and robust demand, but it's scarce supply. So if you look at the demand for gold, actually it's quite interesting because it's pretty much fixed between jewelry that takes around usually half of the demand for gold, jewelry, then we have investment and central banks, and then we move to technological, the industrial use, every space shuttle, a lot of the phones or computers, stereo systems, we use gold. So gold really has a very strong and stable demand, to the point that this demand tends to balance itself. So for example, if you're looking at 2020, the demand for jewelry was down because the shops were closed, people don't have so much money. But the demand for investment products, bullion coins, bullion bars went up because people felt the urge to buy more gold to protect themselves from the effects of the financial effects of the COVID. So you saw jewelry down and demand by investors up. Same way as we see this year, the demand by central banks is up. So that's on the demand side, and the supply, we all know, and especially you in the Philippines, it's such a major gold mining hub. It's expensive to open gold mines. It takes time. It costs a lot of money to produce it. And this creates this gap between supply and demand. And when we invest in something rare, of course, it will always be precious. Now, I want to talk about the liquidity because Gavin actually mentioned it as one of the cons of alternative assets. And here gold is actually very unique. Gold has incredible liquidity in two senses. First, if you trade it with, let's say, a company like us, if you store it in Hong Kong or Singapore, you can pick up the phone, call your RM here or myself and say, sell my position. And most likely will get the money by the end of the day. So this is one of the most liquid assets. There are always buyers between refiners, other clients, jewelry manufacturers. There's always a market. There's a very robust market for gold. It's very liquid. And the other element is on the physical side, you can take the bar of gold and you can sell it in Manila, in Chinatown. You can go here to Hong Kong. You can, if you fly to the US, you can go to any jewelry shop and you can sell this bar of gold or gold coin, which makes it almost cash. It has a cash value to it, if you'd like. You can sell it easily, globally. Even we had a client lately that sold $10 million worth of gold. He got the money within the next business day. So on this, I think gold is quite different than a lot of alternative assets or commodities because it is very liquid. And of course, I think, again, Gavin did a great job to prove the case for gold in terms of portfolio diversification. And as Gavin showed us, gold has negative correlations to the financial market, to the equities. We checked here, for example, how gold was doing compared to the S&P and US Treasury in three specific times of crisis: the global financial crisis, the US-China trade war, and since the start of COVID. And you see, and you saw it from Gavin's presentation, of course, also, gold has an inverse correlation. It's counter to the market. And that's something, if you want to see, except for this, what gold was doing in 2020, when we had most of the markets went down, you see that silver, gold, platinum, and palladium were one of the best performing assets in 2020. Silver went up 50%, gold 22%. Nasdaq did better, but we know Nasdaq was heavily affected by a few tech companies. But look at the S&P, and then you go down to the Hang Seng, to the Filipino Stock Exchange, and to the FTSE. So you see that when the market goes down, and 2020 proved it very well, when the markets go down, gold tends to go up, silver tends to go up. These numbers are for 2020. Between 2019 and the end of 2020, gold appreciated in almost 50%. And the reason was, if you manage to remember the world before COVID, at the end of 2019, we had the correction in the stock markets in the major centers in the US and Europe. And when the stock markets went down, gold already, even before COVID, started to appreciate. So we see what Gavin mentioned is one of the advantages of gold is this low, or I would say, independency compared to the stock markets. But it's not only about the hedging of the risk. It's not only about protecting your portfolio. Gold does have very decent, I would say, long-term returns that are even in par with other assets. You can see here since what gold was doing since 1971, and it was doing not as great as the maybe the emerging markets, but definitely doing very well. And if you're looking at the last 20 years, gold is in par with most assets. So since 1975, gold appreciated an average of 8% a year. And the last 20 years, gold appreciated at an average of 10% a year. And this is quite, I would say, outstanding, because at the end of the day, this is a very, very low risk asset. In a way, we just sold gold, liquidated gold for one of our clients, and the banker managing the relationship with the client told me, listen, the client did 50% appreciation in the last 5 years on their gold portfolio. And he said, I could never get him to get this return without the risk. So if you're looking at 8 to 10% appreciation a year with very low risk, gold is doing a great job in this regard. The last, almost the last thing is what we look at as store of value. I think it's very relevant in the Philippines. The Philippines, we see the market a lot of time. We're talking about family wealth and the question of our what tools we have to pass this wealth to the next generation. And gold is doing a great job here because it's what we call the store of value. So we put here on this graph what you could buy with 1 ounce of gold And we saw how many Big Macs you could buy, how many pounds of coffee, milk, and gasoline you could buy with this 1 ounce of gold. And look at the figures; they speak for themselves. It's incredible. The easiest part, if you look, is Big Mac. You can almost buy the same Big Mac you can buy 20 years ago or 30 years ago today with an ounce of gold. But look how much more gallons of gas you can buy for the same ounce of gold, or how much milk you can buy for the same ounce of gold, how much coffee you can buy for the same ounce of gold. So that's why we say it's a store of value, because when the value of money go down because of inflation, because of money printing, and I'm going to touch that a bit later, you need to think of an asset that you'll have it today, and in 10 years, you can still buy at least the same items. Another great example we know is a suit. In the 70s, a suit cost $35 to $40, which at the time was worth an ounce of gold. Today, if you need to pay with dollars for a good suit, you'll pay $1,000. But if you kept this 1 ounce of gold, you're going to have today $1,800. So it really keeps the value of the money very, very well. And it's especially important when we talk about transitioning of wealth to the next generation. And the question, which I'm including on my mind as a father of young kids, what can I buy today that will have value in 20, 30 years? And gold is really one of the best assets you can do. You can do gold, and maybe Gavin will agree with me, you can do maybe ETFs that follow the S&Ps. But if you try individual stocks, it doesn't work. And gold is really important from this aspect. Now, before I move forward, I want to touch about Bitcoin, because I know I'll be asked about. So we decided to face this question heads on. And the question is whether Bitcoin is the new gold, and maybe the days of gold are over. And out of, I would say, being very open, we do trade Bitcoin. We have a company in our group that help clients buy and sell cryptocurrencies or convert them to gold. So we are involved in this market, but we look at it as a very, very different assets on very different elements of the portfolio. The gold is the more, I would say, defensive, almost insurance policy, the assets that will appreciate slowly in time, low risk, while cryptocurrencies or Bitcoin are the other way. They are risky. You can lose a lot quickly. You can make a lot of money quickly. It's more speculative, but that belongs to the other side of the high risk, high reward. So if we think today of Bitcoin, can Bitcoin outdo gold? My very, I would say, strong conviction is no. Bitcoin doesn't provide you this liquidity that you're looking for. It doesn't provide you the fair market price Kevin mentioned earlier. It doesn't provide you the certainty that if there's a financial crisis, you will keep your money and even make more money the same way we have with gold. Bitcoin may go down with the market, may go up. It's a very concentrated market, and there's just no rules in the crypto world. It's all the Wild West. Anything can happen. And I would recommend, we like Bitcoin, but don't put it in the same basket as gold. It is another asset. Now, just to finish the point about Bitcoin, is just to show you the volatility, the steepest volatility of gold price versus steep decline in the price of Bitcoin, which shows you, first of all, it shows you how different is the data we have on gold versus cryptocurrencies. Gold, we can go back hundreds of years. With crypto, we have 10 years or so of data. So you can see that, and you can see again in terms of volatility why we don't think they're sitting in the same element of your portfolio. So now I'm gonna touch a bit about silver. Silver is a very interesting metal. It's what we call I like to call it the poor man's gold, because of course it's much cheaper. So you can buy more for the same amount of dollars. You can buy more silver than gold. And we're very, very bullish on silver this year, and few reasons for that. And silver is a different metal than gold. It has very strong industrial use, whether it's silver, whether it's, as we see, solar panels, and things like that. So if there's a recession, usually silver will go down while gold may appreciate. But as now, when we're looking at the US new green policies that will require mining a lot of silver, we're looking at silver jewelry bouncing back, demand is bouncing back in China and other jurisdictions. And we see still the silver is being perceived as underpriced compared to gold. So I would mention silver is a very interesting metal to look at. It's more volatile than gold. It's a bit more riskier, therefore, but definitely I would recommend holding silver as part of your precious metal basket, especially in the near future, because it's very, very interesting, the development from the industrial side of it. Now, I quickly want to go on the questions. Of course, Unicapital, we all know that usually trading financial products, as Gavin mentioned, but we're talking about physical gold, like you see here. And the question is, why go physical? Why not to go paper? And it's our, if you'd like, even vision at Rotbart and Company to be very, I would say, particular about buying physical rather than paper. And you can see the summary here. But if I can summarize in two main things. First of all, paper gold meaning ETFs that follow the price of gold. It means a future contract that you can buy or other derivatives. For example, here in Hong Kong at HSBC, I can log on to my online banking and buy gold. I read the terms and condition of HSBC. Basically, they're telling you there's no gold and it's not an HSBC product. You're buying a product from a third party and HSBC is not liable if you lose your money, but they're still selling the product. And if you'd like, that's one of the main differences. When you buy paper gold, you don't buy gold. You buy either exposure to the price, a future contract that is not backed with physical gold, or unit trusts in ETFs. So the underlying asset is not there. You're buying a financial product, which means that from a safety and security point of view, if there's a crisis tomorrow, if you need fast liquidity, you may not find it. You may get locked without your money. So to summarize maybe in one sentence or one thumb rule, paper gold is very good if you want exposure. If you want short-term trading, it's fine. I wouldn't take the bulk of your portfolio and put it in paper gold and just sit on it for years. You're having exposure to the counterparty, you have exposure to regulation, you have exposure to government, and you don't have the asset. So if you decide to buy gold and it's more than a short-term trading, go for the real asset, go for the physical. And this is how a physical gold bar looks like. So each bar has 4 identifying marks. We have the refinery stamp, we have the purity, we have the serial number, and we have the weight. So Kevin, to touch on your point of authenticity, all the big gold refiners are monitored by the London Bullion Market Association. The London Bullion Market Association vet all the refiners, sets the rules for which refinery is included in our ecosystem and is reliable. And hence, when we buy gold, we want to see this refinery stamp. We want to know it's a refinery that is approved by the London Bullion Market Association. Now, having a unique serial number, meaning that you buy your own gold bar, same as you have your own car. You have your number, and you come to the vault. If you store it, you need to see that this gold bar belongs to you. You want to physically see this bar in front of you. For example, one of the things we do with our clients, we send them photos of their items, but also, other than the photos, we send them a storage receipt where they can see all the numbers of the bars. So there's always the question, as I mentioned, given of authenticity. This is how we know it's real. It's been kept, it's been audited, it's been subject to the London Bullion Market Association ecosystem, and this is how we like to keep it. The problem is when clients take gold home and then they want to bring it back in the system, that could be a problem because then we don't know if the gold bar was tampered with. So what we're doing at Rotbart and Co is really to try to make it as professional product as possible. You store it with us in Singapore, in Hong Kong, in Zurich, in London, wherever you want it. That's something that you should decide where, but you always have access to it, and you always can sell it immediately because you didn't remove it from the vault. Now, of course, when we're talking about vaults, there's a storage element, so very important to have insurance for loss. Very important to have what we call segregated storage, meaning that all the items are not commingled. They packed separately and placed on a separate shelf. Full allocation per client, meaning that you own, as I mentioned, your own bar, and it shouldn't be on the custodian balance sheet. It should be your own. No one else is allowed to touch it. And of course, you want to be able to come, see it, or if you want to take it with you. I can tell you one of our biggest clients from the Philippines moved to us from a private bank. And the reason he moved to us is because I kind of tricked him to ask his banker to take this 1 bar of gold from the vault, and the amount of questions and forms and obstacles and hiccups he had to experience before he could take this bar of gold convinced him that actually it's better to keep your gold separate from your private bank or from your other banking facilities, because it's a different asset. You want to keep it separated from your other financial holdings. As I mentioned, when golds come to the vault, and I'll be happy maybe later to share, to send you a link to a video when you can see how it happens. Everything is inspected visually, it's been packed and placed in tamper-proof bags and boxes to make sure it remains there. And most clients buy gold. Some ask for delivery, but most of them will store them for the long term, for 5-10 years. They'll keep it there until they want to liquidate. In terms of storage location, which is always a question by clients, where should we keep our gold? This is the location we offer gold. The busiest are Singapore, Hong Kong, and Switzerland, but for us, it's a question of where the client feels comfortable. Because again, gold as a safe asset needs to be stored where the owner thinks it's safe. So if you, for example, we know, again, we're talking about before COVID, a lot of our Filipino clients would store in Hong Kong because they come here for shopping, they come for short vacations, for food, to enjoy Hong Kong that we love so much. So they prefer Hong Kong because it's accessible. Having said that, in the last, I would say, few months, we do see a shift from Hong Kong to Singapore for political reasons, and we know what they are. The question of the intervention of China here in Hong Kong and the degree of autonomy makes some investors worry. Some prefer to move their assets to Singapore. I think even today, we move some items from Hong Kong to Singapore. That's another problem, to ship it if needed. It's very easy, it's inexpensive, it's done with the insurance. But so you want to know that this option, if you don't feel comfortable with one location, you can always move it to another location. Now, we're almost done, and I want to briefly touch on why we are very bullish on gold also in 2021, 2022, why we think now is a good time to buy precious metals. And the first reason, of course, is COVID. We don't know yet how the world would look like after COVID. There's a feeling that we are, in some countries, are moving forward, the US, the EU, China perhaps. But as we know, in the Philippines, Singapore, here in Asia, there is a big problem. It seems like it's very difficult to contain the virus, and we think this will affect the economy in the future, and we don't know exactly how. So as Gavin mentioned, when there's uncertainty, and there are questions, when there's some fear, gold is doing quite well. So we expect gold to appreciate in the near future. As I mentioned, the liquidity is there and people are looking for a safe haven. So we see a lot of the demand for investment grade gold is really up. I think the average in Q1 of demand for investment, what we call coins and bars, were 50% higher than the 5 years average, meaning a lot of people were buying gold, and we feel it ourselves in our company, but a lot of people are buying gold because they're concerned, they want to keep safe asset on the side in this turbulent world. Quantitative easing is an issue. We just heard the Fed promising to continue printing money, or what they say in economy, expanding the balance sheet or expanding the fiscal basis, you name it. The issue here is this quantitative easing, meaning more debt. And we are concerned with that regardless, with the public and private debt levels in China and the public debt in the EU and the US. The problem is, can this government at some point cover the debt? If not, then we have a problem, and then we cannot trust their currencies. So all this printing of money bring big concerns about the ability of governments to pay their debt in the future, and how will they handle it. And again, we're thinking about the US now. There's so much, I would say, Biden is spending so much money and free education, free college, free child support, and so on. Someone has to pay it, and they're kicking the can down the street to the next generation, and that's for us a big concern. One side effect of the quantitative easing is, of course, the inflation. And we see the numbers from the US. We're standing now at 5% per annum. The Fed is not going to change their policies they announced yesterday or the day before, which makes some of us concerned that when they will decide to tackle inflation, it will be too late. And as Gavin mentioned, gold is a good hedge against inflation. And I just want to mention, it's not because gold has a very strong negative correlation to the index, to the price index in the US and other jurisdictions. It's because the value of our money is going down. We need to pay more. As prices go up, we need to pay more. We need to get more bills out of our pocket. And here I want to go back to the slide where we see that if we have money, on the one hand, we need to pay more for all this product. But if we keep gold, we can just sell it, and it will keep us running for a long time. And I have to tell you, we have one client, American client, residing in New York, older gentleman, and he lives out of his gold. He doesn't keep cash balance in his bank account because I said the inflation kills my balance. I'd rather sell gold. Every quarter he sells 1 kilogram of gold, and that's pays for 3 months. Every 3 months he sells a bar of gold, and that's how he lives. And so it works better than keeping cash. We also have now companies that actually looking at gold from a treasury point of view. I had an owner of a big restaurant group here in Hong Kong saying, you know, I'm keeping Hong Kong dollars in our bank and renminbi in our bank account, but because of the inflation, the value goes down. So maybe we should put gold and sell it as we go when we need the cash. So that's something very important to remember. And if you know John Paulson, the founder of Paulson and Co, said gold always been a safe haven against inflation and a safe haven in times of instability, as we saw now in the time of COVID. Now, before I give the opportunity back to Ed, couple of just to mention who we are. Ed introduced me, but in terms of our company, we're a family-owned business. We understand family and the questions surrounding families very well. We've been doing this for over 10 years. Been doing this for over 10 years. We have office in Hong Kong and Singapore. Unfortunately, Manila at the moment, we don't have someone on the ground, but they're sitting here in Hong Kong because of COVID. They left last year. And I can tell you that Zach, my colleague, is eager to go back to Manila, and I'm actually missing my trips there because I used to be in Manila once a month, and we quite miss that. We offer 10 tax-free storage location with 35 delivery location. In this regard of secure tech storage, I just want to mention the uniqueness of the Philippines as a market and the disadvantage of the Philippines in this regard is there is tax on gold, on importation of gold. And when you sell gold, you can only sell it to the BSP. So what we tell clients, not always they listen to us, but we still keep your items offshore in Hong Kong, Singapore, elsewhere. You can trade it freely. I can tell you very honestly between us here, we have clients that buy gold and buy gold in Hong Kong and carry it in the Philippines. They have the comfort of having this asset with them. The problem arises when they want to sell it, and suddenly they realize there's no market in the Philippines for that because of the legal regulation to sell only to the Banco Central. So I would urge you, if you want to make an investment, a proper professional investment, to store this in one of those tax-free locations that we offer. In terms of services, we offer the full package. It's a one-stop shop. It's a purchase of buying and selling of gold, silver, platinum, palladium, the bars and coins. We offer transportation and storage services. We offer safe deposit boxes, which is relevant for some people who want to keep their jewelry or some important documents. And very important now, we offer lending services. So clients can keep gold with us. And we have a few clients, Filipino clients, are doing that. They can keep gold with us, but they need the cash for their business or for other investment through Unicapital or for other things. Then they can keep the gold with us and take up to 85% back as a loan for a few years. And we find this service to be quite attractive for clients, especially now during COVID. Clients need to settle the cash flow, or they maybe have the leverage on other investment. It's a good way to keep both assets. To summarize, the way we look at it and the way what we're trying, if you'd like, to push you to understand is really in terms of the balance between the price appreciation and the risk. There are very few assets that compete with gold because gold really offers an interesting balance between this low risk and the price appreciation. So I think in this regard, I will maybe first I'll say thank you for the opportunity. I'm sure you'll have a lot of questions from me or Gavin. I'm here and the team is here, and you can feel free to contact us anytime.